3 things just happened in the last 24 hours that confirm everything we've been analyzing. And a 4th thing happened that the financial media is completely ignoring. By the time you finish reading this, you're going to understand why gold just bounced back to $5,000 Dow, why silver is recovering to 78, and why the next move could be the biggest one yet. First, the United States government just confirmed a price floor system for critical minerals, including silver. Second, Hecla Mining, the largest silver producer in North America, just reported their full-year results. And buried inside those numbers is a detail that proves industrial buyers are bypassing COMEX and paying 30% more to buy silver directly from mines. Third, the CEO of APMEX, the largest online precious metals dealer in America, just published a letter saying shipping times are finally back to normal after a full month of delays. And fourth, there are currently 35,000 call options on March COMEX silver futures that are in the money right now. And the banks cannot do anything about it, even after crashing silver 46%. Let me show you why these 4 stories together are the most bullish signal for silver seen since this entire cycle started. And honestly, when all 4 of these hit within the same 24 hours, the timing is almost impossible to believe. Let's start with the biggest story because this one changes everything. Bloomberg reported yesterday that the United States has developed a critical minerals price floor system and is pitching it to allies. This isn't a rumor. This isn't speculation. Under Secretary of State for Economic Affairs, Jacob Hellberg confirmed that multiple U.S. agencies have developed the system and are having active conversations with allied nations. But this didn't come out of nowhere. Let me give you the full timeline because the media is only covering yesterday's headline. They're not showing you the buildup. On February 4th, Vice President J.D. Vance stood in front of representatives from 55 countries at the Critical Minerals Ministerial at the State Department, and he said something that should have been front-page news everywhere. He said the U.S. will establish reference prices for critical minerals at every stage of production. And for members of the preferential zone, these reference prices will operate as a floor maintained through adjustable tariffs to uphold pricing integrity. Let me translate that. The U.S. government is telling the world that critical minerals, which include silver, will have a minimum price, a floor below which the price cannot fall within the trading block, and they're backing it with tariffs to enforce it. This is not a suggestion. The EU has agreed, Japan has agreed, Mexico has agreed, 11 countries signed bilateral agreements, and on the same day, Trump unveiled Project Vault, a $12 billion critical minerals reserve backed by $10 billion from the U.S. Export-Import Bank, and $2 billion in private funds to stockpile strategic minerals and stabilize prices. When you first read this, you have to read it 3 times because the implications are enormous. A price floor means the U.S. government is essentially saying we will not allow the market to price silver below a certain level. That's not free market economics. That's strategic economic warfare. And the fact that 55 countries are sitting at the table tells you this is much bigger than most people realize. Think about what this means for silver. The U.S. government has now officially acknowledged that the free market price of critical minerals is broken, that China's dominance in processing and refining has distorted prices to the point where Western companies cannot compete. And the solution is not to let the market figure it out. The solution is to set a price floor. This is the most bullish policy development for silver in decades. And that's not an exaggeration because if silver has a government-backed price floor, every ounce you hold has a backstop. The government is telling you your silver will never fall below a certain level within this trading block. That changes everything for miners, for industrial buyers, and for anyone holding physical metal. And here's what is fascinating. This announcement came out on the same day that silver was trading at $74, down from $121 after the biggest crash in 46 years. The U.S. government looked at silver at $74 and said, "The market price is broken, it's too low. We need to put a floor under it." Read that again. The government of the United States is telling you the current price of silver is artificially low. Now, this is where it connects to China's silver export controls. 44 companies licensed silver reclassified as a strategic material, the same regulatory footing as rare earths. What Vance is doing with the price floor is the Western response to China's export controls. China is restricting supply. The U.S. is guaranteeing price. Both actions point in the same direction. Silver is going higher. The only question is how much higher. And if you're wondering whether silver is actually included in the critical minerals list, let me remove all doubt. The U.S. government designated silver as a critical mineral through the new Strategic Reserve Project. The Section 232 investigation concluded that imports of processed critical minerals threaten to impair national security. Silver is used in every advanced weapon system, every solar panel, every semiconductor, every piece of military hardware the U.S. produces. It is definitionally critical. Now, let me show you what Hecla Mining just revealed. Hecla Mining Company released their fourth quarter and full year 2025 results yesterday. Revenue over $1.4 billion, up 53% from last year. Net income $321 million. That's 9 times more than 2024. 9 times in 1 year. These are the best numbers in Hecla's entire 135-year history. A 9 times increase in net income is not normal. That's what happens when an entire market reprices around you and you're sitting on the supply side. But those aren't even the numbers that matter most. The average silver price for the fourth quarter of 2025 was $54.83. That's the market average, the benchmark price. What COMEX said silver was worth. Hecla's average realized silver price in the fourth quarter was $69.28. Let me make sure you caught that. The market said silver was $54.83. Hecla got $69.28. That is a $14.45 premium, nearly 30% above the average market price. Not in Shanghai, not in some back alley deal. In America, from America's largest silver miner, reported to the SEC on the record. That's not a rumor. That's an audited financial statement. Now, how does a mining company realize a price that is 30% higher than the market average? There are only 2 explanations. Either Hecla held back production and sold everything in late December when prices spiked higher, which would mean they were timing the market rather than selling steadily. That's possible but unusual for a company of this size. Or industrial silver buyers are going directly to silver mines and paying a premium to secure physical supply, bypassing COMEX entirely, because they need actual metal for manufacturing, and they cannot rely on the exchange to deliver it. The second explanation is the more likely one, and here's why. Samsung locked up 100% of the output from the La Pria silver mine for 2 years through a direct prepayment deal. London lease rates hit 9% in October because institutions were desperate to borrow physical silver. Shanghai physical silver trades at a 20% premium to paper. And now the largest silver miner in North America is reporting a 30% premium on their realized price. This is not a coincidence. This is a pattern. Industrial buyers are going around COMEX. They're going directly to the source because the exchange cannot guarantee delivery. And when buyers are willing to pay that kind of premium to get silver directly from mines, that tells you the real price of silver is not what COMEX says it is. The real price is what someone will actually pay to get their hands on it. And right now, that price is far higher than the ticker on your screen. And this connects directly to the Shanghai premium pattern. Physical silver in China at $99, while COMEX says $74. Now, there is a U.S. miner confirming the same pattern from the supply side. The mines are getting more than the market price because the market price is wrong. The CEO called 2025 transformational. A year ago, they were carrying hundreds of millions in debt. Now they're essentially debt-free. Silver did that in 1 year. And looking ahead, Hecla is making a move that is one of the most important signals in the entire mining industry right now. They're selling their gold mine for almost $600 million to go all in on silver. Gold is at $5,000 and they're selling the gold mine. Let me say that again. They are choosing silver over gold at $5,000 gold. These people know something. Their 2026 guidance calls for 15 to 16.5 million ounces of silver production, and they're nearly doubling exploration spending to $55 million, and their cost structure tells you why they're this confident. All-in sustaining cost, $18.11 per ounce. Realized price, $69.28. That's a $51 margin on every single ounce, 74%. Their Greens Creek mine in Alaska reported a negative cash cost after byproduct credits. Negative. They're getting paid to mine silver. That's how profitable this is. Now let me show you what the CEO of APMEX just told his customers, because this one is personal for anyone who buys physical silver. Ken Lewis, the CEO of APMEX, published a letter to customers on February 17th yesterday, and the key line reads, "Shipping times and customer service levels have returned to the fast, reliable standards you expect and deserve." Sounds like good news, right? Shipping is back to normal. Problem solved. But he also said he thanked customers for their patience, understanding, and trust during one of the most extraordinary periods the precious metals market has ever seen. He said they experienced unprecedented demand, record prices, and supply challenges that put pressure on the entire industry. Let me put this in context. APMEX is the largest online precious metals dealer in the United States, and for roughly a month, they could not ship silver on time. They added 4 extra business days to every estimated ship date. They reduced their product selection to 31 core products and could only keep 21 of them in stock. They increased customer service headcount by 25% just to handle the volume, and they experienced weekend order volumes that were 7 times higher than normal. This is the largest dealer in the country with decades of experience, with massive warehouses and minting operations. And they were overwhelmed for an entire month. And some people know exactly what this means because they placed an order in January and waited weeks. Some may still be waiting from other dealers. If that doesn't tell you the physical silver market is broken, nothing will. Now here's the important question. If APMEX is back to normal, is it because supply caught up with demand? Or is it because the 46% price crash scared enough buyers out of the market that demand temporarily dropped? It's the second one, and here's why. The APMEX letter says many firms across the industry are still working through supply constraints and service challenges, so other dealers are still behind. APMEX caught up, others haven't. And the timing is worth noting. The crash happened on January 30th. APMEX says they're back to normal on February 17th. That's 18 days. 18 days for APMEX to clear their backlog after the crash temporarily reduced buying pressure. So, what happens when silver starts running again? When prices recover? When the next wave of buying hits? If it took APMEX a full month to catch up after a crash killed demand, what happens when demand comes back? The answer is the same thing that happened before. Delays, shortages, premiums, and the cycle starts all over again, just in time for silver to begin its next move. And to be clear about something, the fact that APMEX had to write this letter at all is the story. A CEO does not publish a letter saying, "Please be patient. We can't ship your silver," during normal times. This letter exists because the physical silver market broke for a full month, and they're telling you it's fixed now. But the structural shortage that caused it hasn't changed. The deficit is still running, the inventory is still draining, and the demand is still growing. Also worth noticing is what he called this period, one of the most extraordinary periods the precious metals market has ever seen. The CEO of the largest precious metals dealer in America, a man who has seen every market cycle for decades, is calling this the most extraordinary period ever. That's not the language of someone who thinks it's over. That's the language of someone who knows what's coming next and is getting his operations ready for round two. This is what the cycle looks like. Prices run, demand explodes, dealers can't keep up, then prices crash. Demand drops temporarily, dealers catch up, then prices run again, and the cycle repeats. But each time the structural deficit gets worse, each time the inventory gets lower, each time the recovery takes longer. We're at the part of the cycle where dealers just caught up, which means we're about to enter the part where demand returns. And this time, the vault has less silver than last time. Now, the fourth piece, and this is the one that connects everything to February 27th. There are currently approximately 35,000 call options on March 2026 COMEX silver futures that are in the money. These are options that give the holder the right to buy silver futures at prices below where silver is currently trading. They are profitable right now, and here's why this matters. Traditionally, the bullion banks, the big commercial shorts, try to slam the silver price before options expiration to prevent as many calls from expiring in the money as possible. We saw this on January 30th. They crashed silver from 121 to 64 in a single session. That was the slam. That was the attempt to knock every call option out of the money. And it didn't work. Even after a 46% crash, 35,000 calls are still in the money. The banks lost control of the silver price to such an extent in January that even the most violent crash in 46 years couldn't kill enough of these options. Silver has recovered from 64 to 78. And every dollar it recovers, more calls come back into the money. Now, here's the question that should keep every bullion bank awake at night. What happens if a significant portion of these in-the-money call option holders exercise their calls? If they exercise, they receive a long March silver futures contract. And if they then stand for delivery on that contract, they are demanding physical silver from COMEX, the same COMEX that has 98 million ounces of registered silver against 400 million in open interest. This is the scenario that warrants serious attention. The crash was supposed to wipe out the calls. It didn't. The crash was supposed to reduce delivery demand. It didn't. February deliveries are running at 98%, and now 35,000 calls are sitting in the money with 9 days until first notice day. And to put a number on this, so the scale is clear, each COMEX silver futures contract represents 5,000 ounces. 35,000 call options, if exercised, would represent 175 million ounces of potential delivery demand. The vault has 98 million ounces registered. Even if only a fraction of these calls are exercised and stand for delivery, the math doesn't work. The vault doesn't have enough metal. Now, will all 35,000 exercise? No. Most options traders close for cash. They don't want the metal. But here's what's different this time. We are in an environment where industrial buyers need physical silver, where Samsung is locking up entire mines, where Hecla is getting massive premiums from direct buyers, where Shanghai physical silver is 20% above paper. In this environment, The incentive to exercise and take delivery is higher than at any point in modern history. Because if you can get COMEX silver at $78 through an exercise call and sell it to an industrial buyer at $90 or $100, you're printing money. The arbitrage is real and smart money knows it. Let me connect all 4 of these stories because separately they're interesting. Together, they tell you everything. And this is where it gets undeniably clear, because when you lay it all out, the picture is so compelling it's hard to understand why the mainstream financial media isn't screaming about it. Here's what nobody's putting together. The price floor is the government admitting the market is broken. Hecla's numbers prove it's broken from the supply side. Miners are getting 30% more than the paper price. APMEX proves it's broken from the demand side. The largest dealer in America couldn't ship for a month. And 35,000 ITM calls are about to test whether it can survive being broken from the delivery side. 4 different angles. Same conclusion. The paper silver market is dying, and the physical market is replacing it in real time. Now let me walk through what's happening in real time. Gold is recovering to $5,000. It touched $4,900 earlier this week and bounced hard. It's trading right around $5,000. The recovery is happening because the market is digesting the price floor news. When the U.S. government tells 55 countries that critical mineral prices need a floor, capital starts flowing back into the metals that were just crashed. Silver is back to 78. It bottomed at 64 on January 30th. In 3 weeks, it's recovered 22%. And something important about the recovery pattern deserves attention. Silver crashed 50% in one day and has been grinding higher every day since. That's not the behavior of a bubble that popped. That's the behavior of a market that was artificially crashed and is now reverting to its real price. Bubbles don't recover in straight lines. Engineered crashes do. And here's what's driving the recovery beyond just the price floor news. The fundamentals haven't changed. The 6-year supply deficit is still running. COMEX inventory is still at 98 million ounces. Shanghai premiums are still 20%. Chinese markets are still closed for New Year. The delivery rate in February is still 98%. Nothing that caused the crash addressed any of these structural problems. The crash was a band-aid on a broken bone, and the bone is still broken. The price floor changes the game. It tells miners to invest. It tells industrial buyers to secure supply. It tells investors that the government has their back. And it tells the shorts that the floor is being built under your feet while you're standing on the wrong side of the trade. The sentiment has shifted. Before the price floor announcement, the narrative was, silver crashed, therefore the rally is over. After the price floor announcement, the narrative is becoming, the U.S. government just confirmed that silver is underpriced. Those are 2 completely different stories, and the second one is the one that moves capital. So the next time someone says the silver rally is over, ask them one question. If it's over, why is the U.S. government building a price floor for it? And here's the piece that ties it all together with previous analysis. The CVOL was at 115, volatility higher than the all-time high. That was the options market telling you something massive is coming. Now, we know part of what's coming, a U.S.-backed price floor for critical minerals, Hecla confirming that the real price of silver is far above the paper price, and 35,000 ITM calls approaching first notice day. And remember the full picture, the Fed injecting billions in emergency cash, JP Morgan short 5,900 tons, and a Wall Street strategist on Bloomberg Terminal saying gold is a bet on America's failure. Now look at what the U.S. government just did. They built a price floor for the exact metals that narrative was trying to make you feel ashamed for buying. The government is betting on silver with 55 countries at the table. While the media was telling you buying silver makes you anti-American, the U.S. government was doing the opposite. You can't make this stuff up. When the most informed people in the silver industry, the people who literally pull it out of the ground, are making the biggest bet of their corporate lives on silver going higher, that speaks for itself. So here's the full assessment. The U.S. price floor is the most bullish policy development for silver in a generation. Hecla's 30% premium proves the physical market has already separated from the paper market. APMEX's month-long shipping crisis proves physical demand overwhelmed the entire dealer infrastructure. And 35,000 ITM calls prove the January crash failed to achieve its objective. Gold at $5,000, silver at 78, 9 days until first notice day, Chinese markets reopening on February 24th, a U.S.-backed price floor in development, industrial buyers paying premiums directly to mines, and the largest silver producer in history just had the best year in its 135-year existence. This is analysis, not financial advice. Do your own research, make your own decisions. But every piece of data, every government action, every corporate filing, every market signal is pointing in the same direction. The price of silver on COMEX is not the real price of silver. The real price is what Hecla gets from industrial buyers. The real price is what Shanghai charges for physical. The real price is what the U.S. government is about to set as a floor. And all of those prices are much higher than what any screen says right now. You can print contracts, you can crash prices, you can write letters saying shipping is back to normal, but you cannot print silver. You cannot manufacture 135 years of mining expertise overnight. And you cannot unconfirm a US government price floor once it's been announced to 55 countries. The floor is being built, and silver is standing on it.